Welcome to the CLS Market Review for the month of January 2014. I'm Matt Harwell. After its best calendar year since the late 1990s, the S&P 500 posted its worst month since May 2012 in January. The S&P lost nearly 4%. Losses were shared by other markets. Small-cap companies lost 3%, international stocks lost 5%, and emerging market stocks lost 9%. The bond market, however, performed well, with the overall market gaining nearly 2%. The 10-year Treasury yield finished the month just above 2.6%. Is January the start of a deeper and darker market correction? Should investors be nervous? For insight, let's turn to CLS's Chief Investment Officer, Rusty Vanneman. Rusty.
Thanks, Matt. That is indeed the question on many people's minds. Should we be worried? I think the short answer is no. Most likely, this recent pullback is not going to develop into a correction, never mind a bear market. Second, even if it does turn into a correction or a bear market, remember it's just normal market behavior. Corrections happen. For long-term investors, it's just best to consider a potential correction a step back before the market's eventual next 2 steps forward. In addition, for long-term investors, market volatility often provides opportunities to enhance future returns. If, however, a potential temporary loss of 20% or more may cause harm to your financial objectives, then by all means revisit and review your risk tolerance with your advisor. If a move to a lower risk budget is in order, please make sure it is due for appropriate reasons and not simply for trying to time the market. This all said, it does seem a bit extraordinary how much excitement there has been over this recent market pullback. Thing is, as of month end, the market, at least defined by the imperfect S&P 500 index, is only about 4% off its all-time intraday highs from January 15th. Then again, the market has had a nice run, and it shouldn't be too surprising to see some investors a bit agitated, particularly if they increased their stock market holdings recently. What hasn't been normal has been the price action over the last year plus. Despite strong price gains, overall volatility has been extremely low by historical measures. In addition, the market has been long overdue for a pause to refresh. In fact, it has been since May 2013 that the market has even fallen 5% from its prior highs, and since May 2011 for a 10% correction. We haven't seen a bear market since the last one ended in March 2009, nearly 5 years ago. For some perspective, how are corrections and bear markets defined, and how often do they occur? First, a correction is defined as a loss of 10% or more. Since 1945, there have only been 27 corrections, or about one every 2.5 years. Again, it hasn't even been 2 years since the last correction. A bear market, meanwhile, is defined as a loss of 20% or more. Since 1945, there have been 12 bear markets, or about one every 5.5 years. The last bear market was nearly 5 years ago. In sum, could this be the start of a more substantial correction? Whether the pullback gets deeper or not, I believe it's just healthy market behavior. It will clear some of the excessively bullish sentiment and create a more balanced market environment where fundamentals can reassert themselves as a primary driver of market returns. If that's what we get, let's indeed consider the price action the pause that refreshes, or the step back before the next 2 steps forward. Stay balanced.
Thank you, Rusty. For a discussion on some of the potential reasons for the recent losses, I invite you to download our monthly market commentary PDF and podcast. That concludes our update for the first month of 2014, and we hope to see you back next Tuesday. Thank you very much for your time and trust in CLS Investments.